Hi friends, Simit here from informedtrades.com. In this video, I want to take a look at a concept known as free gold, discuss what that is and what that implies about where the gold market is headed. This is related in a way to the concept of gold balancing the sovereign debt crisis, the international debt loads that nations have. So we have a video on that. After you're done watching this video, that may be something worth checking out. We'll have links to it below this video as well. Basically, the key points in the free gold thesis are: one is that gold will be a reference point and a store of value, and we'll get into a little bit what that means shortly. This school of thought, foresees hyperinflation for the U.S. dollar. One of the arguments against hyperinflation, in terms of those who believe that it cannot occur, is where will capital go to? If it's not going to go in the U.S., where will it go to? Free gold basically argues that it will go to the euro and other currencies whose central banks have gold reserves that they're marking to market value. ECB does have gold reserves that they are marking to market value. There are other central banks doing this, and central banks as a whole have been acquiring gold. The free gold thesis is that gold will be revalued one time to a much higher price to balance the international debt load, and this should be a significantly higher gold price. But before that occurs, Comex will fail and the gold price will go down, perhaps significantly. But we'll get into that, and that doesn't necessarily mean that one should delay buying gold if one is ultimately bullish on it. Biggest risk will be at the time of revaluation. So once that gold is revalued, that's the time where you really have to be concerned about your gold being stolen or something happening where you're not going to get to enjoy the profits of revaluation. In terms of mining shares, they could be taxed, and that's another thing that could come in at the time of revaluation. One of the most popular blogs for learning more about this is fofoa.blogspot.com. There's also many links from there, so you can read a whole bunch about this thesis as well as other summaries from around the web by going to that URL. This video is just a summary. I really tried to boil down the short or the most vital concepts to it from a trading investing perspective. Of course, there's a lot more to it, and you can learn more about that at that website. Okay, gold will be a store of value and a reference point. Basically, in the free gold thesis, there's three components to money. There's a medium exchange, what you use to pay for stuff; a unit of account, in terms of keeping track of value and being able to compare two goods or services that are completely different by a numerical amount; and a store of value, savings. In the free gold thesis, gold is evolving to a point where it will just be a store of value, and fiat currencies will be the medium of exchange and the unit of account. So this is different than the gold standard view, in which gold is more directly tied to the medium of exchange and unit of account. This is gold gold coexisting with fiat currencies, but it being a store of value. And as a reference point, it means basically that other currencies, when they want to convert to each other, will go through gold. So basically, gold will be the center of the monetary system in a way, the new monetary system that's coming. And it's basically, it's very similar to what we already have in place. I think the difference is that once the new monetary agreement is in place, gold will be revalued at a much higher price, and it'll basically trade in a much narrower or more controlled range, where the central banks are agreeing to sort of keep their currencies in check based on their value, their overall relative value to gold. Okay, hyperinflation for the U.S. dollar, and here we have the Germany hyperinflation chart on the screen. This scenario is expected by a lot of those who subscribe to free gold, basically that you're going to have a very sharp decline in the value of the U.S. dollar, as is consistent with historical episodes of hyperinflation. The idea is that the capital will just increasingly flow out of the U.S. dollar and into currencies that are, in a way, or whose central banks are marking their gold reserves to the market price of gold. That's the basic idea, and with quantitative easing going on, capital will just be printed. There'll be a bank holiday of sorts, and gold will be revalued at that time. There was a bank holiday in the U.S. in the 1930s, and gold went from $20 an ounce to being $35 an ounce. That's a similar type of thing that is expected to occur this time with the free gold thesis. Bank holidays, of course, the term banks use for a shutdown. Perhaps a bank strike or a bank closure would be a more accurate term. Currencies with mark-to-market gold reserves will rise. That's part of the free gold thesis, and euro is really the leading example here. So here's the blue line. This chart is a little, in light of the gold price decline in recent months. The blue line might be a little lower, which is the value of the ECB's gold reserves, and the red line is a foreign currency. Basically, the European Central Bank is marking its gold to the market value, and that is rising. So we have a number of central banks that are accumulating gold market to market, and that's a bigger part of their reserves. And that's sort of it's not so much that gold is backing the currency, but it does show that these central banks are storing their wealth in gold. And the idea is that individuals will do this as well. So fiat currency will still be the medium of exchange and the unit of account. Gold will be the form of savings, the store of value. And this trend is related to, or sort of at the heart of free gold in a lot of ways. The one-time revaluation, and this is actually an image that we have from an infographic and video that Informed Trades put out earlier, where there's all these countries that have a lot of debt. They're not going to be able to pay it off. What they do have some of is gold. If that gold is revalued at a significantly higher price, that can balance their debt. Now, what exactly that price is yet to be determined. It would depend on a new monetary agreement. It could be if there's some debt canceled, that could affect the revaluation price. At the same time, a lot of these economies are still adding debt, so that could also send the price higher. But this is the basic concept that illustrates where the one-time revaluation is coming, and also it shows a much higher price. For instance, the U.S., and this is just looking at the U.S. economy. The Federal Reserve has 287 million ounces of gold. It's going to need to be at the current price of, well, this is price 1650, so it's even lower now. But compared to its debt, even if we exclude large portions of its debt, it still needs to go much, much higher. Okay, now this is something that I think is particularly interesting, and it's something that those who have been really passionate about free gold have been arguing or have been talking about for quite some time. And it seems to be that this is what personally got me really interested, or I've been looking at this thesis for a while, and then when I saw this sort of happening, I was like, wow, this is really, at least it gave the thesis more credibility to me. And the basic idea is that they view the free gold thesis is in part about Comex and LBMA. These markets that are for pricing gold are going to fail. And as that fails, the price of gold will actually decline, perhaps significantly. And that's what we've been seeing the past couple months, where gold is, dropped in a kind of a strange fashion. 400 tons of gold were sold in a very short amount of time. The price started declining. And what we are seeing, and this is what you see on the screen right now, Comex inventories are being withdrawn. So gold from Comex is being taken out. And at the same time, we've seen lots of reports of gold buying in Asia and even in the US and many parts of the world. So the idea here is, the price that's being set by Comex and LBMA will continue to decline as it just becomes a paper market where there's no real gold in this market. Kind of a fraudulent market in a way. But the thing is, or the next logical question is, well, if the price is going to continue declining, why don't I just wait until the Comex price is $300 an ounce, for instance, or even lower maybe, and buy as much gold as I can then before the revaluation? Well, the issue is, are you going to be able to find it as gold price continues to decline? So basically, this decline that we've seen over the past couple months has been met with a significant amount of buying in Asia and the US, if this decline continues, it may become harder and harder to get physical. So, if you were thinking, oh, well, maybe I'll just wait until, Comex price keeps declining and becomes just a paper market, it's completely disconnected from actual physical gold, you run the risk of not being able to acquire it because it's all been bought, by all the people that are running out now to get it. So that's something to consider. The other viewpoint is that, once the Comex and LBMA markets collapse, then you'll have the revaluation and price is going to go much higher. Some other considerations is the peak point of risk is when the revaluation occurs, or if you believe this thesis, and if a revaluation occurs, the moment of maximum risk is going to be when that revaluation occurs. From this perspective, a lot of advocates of free gold are all about having physical gold in their possession. There's a concern that when the revaluation comes, it just becomes too easy, especially in a market where Comex has one different price and the actual physical price is something else. There's just too much room for games being played. Having physical in your possession is, from this perspective, what's seen as the safest. Of course, there's once you have in your possession, you're actually responsible for maintaining its security. So there's different ways of looking at it. But mining shares is one thing that they're expecting, or a lot of people who believe in free gold are expecting mining shares to be taxed significantly. So if you believe a revaluation is coming, and then governments will tax mining profits after this revaluation, that would mean it's difficult to, or it's not really the best opportunity to buy mining shares. And that's sort of the basic idea in a nutshell. I know we've covered a lot of topics in this video and probably glossed over a lot of things that could be delved into much greater detail. This is just an introduction, cover the core concepts. Like I mentioned, there are a bunch of URLs on the website around the internet that you can learn more about this topic, and we'll have some more on informed trades as well. Any questions, anything you want to add, join us at informedtrades.com. Thanks and best of luck in your trading.